A very good morning, ladies and gentlemen, and welcome to Nivesh India, an initiative by NSE Investor Protection Fund Trust and ET Now. It is a well known fact that Indian markets are dominated by foreign institutional investments. However, that trend is slowly and surely changing. With the savings rate dropping to 30% in India and investors seeing the merits of investing in equities, we are moving towards a scenario where a few years down the line, domestic investors, retail, and institutions will benefit the most from the rise in the Indian equity market. However, in terms of overall penetration, as you all know, it's just still 2 to 3% of the total population in India accessing and investing in the Indian equity markets directly. While mutual funds, of course, that number is higher. Hence, this initiative by NSE Investor Protection Fund Trust and ET Now, it is a movement, and we are calling it a movement, spanning across 12 cities that will encourage potential investors to invest more in equities and thus be part of the India growth story. Without any further delay, let's get straight down to the proceedings of the day. I'd now like to call upon stage Mr. UK Sinha, Chairman SEBI, Ms. Chitra Ramkrishna, MD and CEO NSE, and Mr. M.K. Anand, MD and CEO Times Network on the dais to light the lamp. I would now like to invite Ms. Chitra Ramkrishna, MD and CEO NSE, to give the welcome address. Another round of applause for her, please.
I'm indeed very grateful to the SEBI chairman for agreeing to flag off this event. Sir, thank you very much for taking the time. It's a source of great encouragement for us in each of these initiatives to see your presence and to hear your words. NSE has, over the last decade, been committed to spreading investor education, which has expanded to financial literacy. We look at investor education, investor awareness, and financial literacy as a basic condition for market strength and for market growth in the long term. It is with this in view that we have embarked on this Nivesh India journey. Something that is unique about this current program, where we have tried to bring some innovation, is that we have tried to reach non-metro, or may I say tier 2, tier 3 cities in this outreach this time. 12 cities and about 20 programs. The second thing we have tried to do here is multilingual approach for the investor outreach. And third, while there are strong ground level outreach programs that we have structured jointly and worked on, we will leverage on the availability of the electronic media so that we are able to transmit this and spread this to many, many more investors outside these 12 cities as well. So we look at this as a small baby step, and encouraged by the response for this, we can certainly build a broader platform and perhaps be able to impact many more in the years to come. With these few words, sir, may I once again thank you for your encouragement and presence here today. Thank you very much.
Thank you, Ms. Ramakrishna. Now I'd like to call upon stage Mr. M.K. Anand, MD and CEO Times Network, to share his thoughts, give a special address. Mr. Anand.
Welcome to Nivesh India, a joint initiative between India's largest stock exchange, NSE, and India's #1 financial news brand, ET Now. While we have been working on this project for some time now, I think the timing that this launch is happening is very, very apt. Investor behavior in equity investing is pretty disappointing. Less than 2% of all household savings comes into the capital markets. We are culturally and financially still caught in an agrarian mindset. Most of our wealth goes into real estate and gold and stays locked, yielding less than inflationary returns. What is needed is a mindset change, and that is a communication job, an education task, a mission that a media group of our stature, I think, is most suited to do. Times Network reaches 1 crore English viewers every month, a number larger than all English newspapers. That, combined with the awesome power of our newspapers, is the ideal platform that will support our lead player, ET Now, to take on such a daunting task of clarifying and simplifying stock markets to Indian investors. Under SEBI's guidance and with NSE as our partner, we are certain that what we are starting here will snowball into one of the largest investor education drives in the world. We look forward to contribute through this to building a stronger India. Thank you.
Thank you, Mr. Anand. Well, it's that time of the day then where I'd request Mr. U.K. Sinha, Chairman SEBI, to formally inaugurate the initiative of Nivesh India.
Participation of retail investors in India's equities markets is abysmally low. Less than 1.5% of the population invests in securities. Exposure of India's household savings to equity amounts to only 2%. In the near future, interest rates are likely to be on a downward trend. Fixed income instruments are likely to be delivering lower returns. To help a large base of Indian investors to benefit from the Indian growth story, the need of the hour is to channel more participation from Indian retail investors in equity markets. The main reason for low retail participation in equities is the lack of knowledge of how the markets work and proper advice of where to invest. It is to fulfill this very need that NSE, India's leading stock exchange, and ET Now, India's #1 English business news channel, have come together to launch a unique initiative. The main objective of this initiative will be to spread investor education to retail investors located in different parts of the country. The initiative will travel to 12 cities, host 19 on-ground investor education camps, and reach out to nearly 1,000 captive retail investors as audience with the objective of spreading the knowledge of investing in the equity markets. Ladies and gentlemen, today we witness the launch of one of India's most informative and definitive investor education projects. NSE Investor Protection Fund Trust presents Nivesh India, an ET Now initiative.
That's the formal launch of Nivesh India, an initiative by NSE Investor Protection Fund Trust and ET Now. Mr. Sinha, you've taken time out from your busy schedule to grace this event. Maybe have a few words from you, sir, on this initiative.
I want to compliment NSE and ET Now for jointly working out this strategy on investor education. So I would like to compliment on this concept of Nivesh India, and the important thing to note is that for an uninitiated investor, for an investor who is perhaps going to be a first-time investor, he is a potential investor, there are a lot of worries in his mind. So a knowledge about the way investment can be made, a knowledge about the market is the first requirement when anybody can take a call. You may be a doctor, an engineer, a teacher, or a very good professional in an own area, but when it comes to making investments, it requires a certain amount of preparedness, it requires a certain amount of knowledge. And that is where all these initiatives are going to be very, very helpful. Unfortunately, in our country, workers' retirement money in an organized way was not being invested in the market. Fortunately, now a decision has been taken and the EPFO has already started investing into the market. For me, it is a big acknowledgement of trust in the Indian market, a trust in the Indian regulatory system, that now workers' money is coming into the market. And I am sure other pension funds will also start looking at the opportunity that the Indian market can provide in the long run. So this investor education, I am sure, will not only tell the viewers about how to go about investing in the market, but also provide enough caution for people to safeguard them from any possible misuse by unauthorized persons. While we are doing our thing in this area, as you know, as a regulator, our first attempt is to educate the people, also to have the systems in place. But when it comes to action, we cannot be found lacking. I wish you all the best for this initiative, and I'm sure more and more of these things will come through NSE and ET Now in future. Thank you very much.
Thank you very much, sir. We are also hoping that this initiative makes a dent in investor psychology and behavior. Thanks once again. I'd like to call upon stage Mr. Nikunj Dalmia, Chief Editor Financial Markets, ET Now, to moderate a session on Indian equities, the way forward. Yes, we could have a round of applause. And our esteemed panelists as well. Joining him on the panel are Mr. R. Kumar, CIO Axis AMC. Could we have a round of applause for him as well? Mr. Harsha Upadhyay, CIO Kotak AMC, and Mr. Tushar Pradhan, CIO HSBC Global Asset Management. Thank you very much, Nikunj. I'll hand it over to you.
Thank you, Tanveer. Good morning, ladies and gentlemen. We at ET Now are excited to really associate ourselves with this wonderful initiative. We deeply feel that this is the need of the hour. Now, equities as an asset class is very well known to the house here and to some of our television audience. But my limited point here is that if the India story is so good, why are Indian investors not really investing in Indian equities? It is appalling and sad to see some of our best companies are currently owned by foreign institutional investors. India is the land of promise. World is contracting, but India is expanding. What drives equity as an asset class is growth, and India has a lot of growth to offer. So without wasting more time on the introduction, I'm just going to throw that question to Tushar. And Tushar, the world is hungry for growth. India is offering a lot of growth. Indians, they're obsessed with gold. They like to park money in fixed deposit. No one is buying stocks.
I think for us to really become a nation of investors, we need to educate ourselves about what equity investing is all about. Typically, Indian investors think that equities is about betting or gambling or some such difficult way to describe what happens in the market. And of course, these events which make the markets fall dramatically are not really any great advertisement for people to get enthused about the market. So I think it's a matter of education that people need to know that when you buy equities, you are buying ownership in a company. You know that companies become successful, and if you want to be part owner, obviously you needed a lot of capital, but because you don't have that kind of capital, the easiest way to be part of this growth story is to buy equities. So I think a simple concept like that needs to be very well understood by most of Indian investors to really become quite excited about this growth story forward.
Harsha, India is a country of savers, but not a country of investors. Even though we have the finest regulator, some of the finest exchanges, investors' money is protected, everything is electronic, yet the cult, the culture, or the entire habit to save or invest in equities is not there.
True. I think, as you rightly said, India is one of the markets where the trading platforms are very well sophisticated. There is a very good regulator who is governing the whole stock market or capital markets. But somehow, I mean, the investors still look at equities for short-term thrills rather than long-term sustainable wealth creation. You compare equities with any other asset class, for example, the tax advantage that the equities give is phenomenal. There is no other asset class which gives you similar tax advantage. And also in terms of the returns over a long period of time, nothing else can beat equities. But somehow there is a thrill that whether the stock prices are moving up or down on a daily basis or even hourly or by minutes, people look at it and they get a lot of thrill. But what they don't realize, as Tushar rightly said, it's not about investing today and looking at the price tomorrow. It's actually partnering a business and growing along with the business growth, and that takes time. So ideally, one should be looking at a longer number of years when you are investing equities. And that's the message from mutual fund side. We are trying to take it to investors. Obviously, it's a very slow and gradual awareness that's building in.
Shiv, let's talk about Indian psychology. When we buy a car, the first thing we ask a dealer is kitna average deti hai. When we put money in fixed deposit, we know the assured return. When somebody is investing in debt instrument, the downside is protected. In property, they never lose money. That's the mindset. Equity never gives you a short return. So why should one invest in equities?
The point about the culture is very important here, because we, as the equity markets in India, really in the last couple of decades, so we really don't have long-term experience. You go and meet investors or in overseas markets, they invest for equities for 10 years and longer. And in India, you think 1 year is long-term capital gains, right? In India, you have 1 year long-term capital gains for equity and 3 years for debt. So you kind of, you think in terms of equity is already long-term when it is 1 year, 2 years, but really equity is long-term when it's 5 years, 10 years, 15 years. If you look at it on a holding period of 5 years, 10 years, 15 years, there's no downside in equity. And I think that's once we need to move horizons. We need to start thinking not in terms of the returns for the next year, but the compounded returns over 5 years, 10 years, 15 years. And over the last 10 years, for example, the markets have given you 15% per annum, and that's on indices. Obviously.
Give me an example. If somebody had put in 1,000 rupees 15 years ago in an index, or let's say an NSE ETF, how much is that multiplied by?
Just give you an out of the top of my head, let's say the BSE 100 in 10 years has gone up about 4x. So 100 investors become 400.
That's tax-free.
That's tax-free.
That's a part of compounding.
Yeah.
Tax-free 4x. No other asset class gives us this kind of return. So the pitch is very clear that equity should be an important part, and if you're not there, I guess it's time that we really revisit our financial planning. So she was talking about sale, and Tushar, same time last week there was a sale, a 10% sale in all global markets, more like a Flipkart sale. 10%, 15%, 20%, everything was off. That time nobody was buying. Why is that?
The point is that I think Shiv made a very good point, that the right time to buy is when the world is coming to an end, right? But that's a very difficult thing to do. So what we suggest is that instead of timing the market, because timing will of course give you outsized returns, but I'm saying forget about outsized returns. Just make a habit of investing something very regularly over long periods of time. And the compounding that you get there is also one of the highest that you will ever see. And I think that is a habit which has to be kind of encouraged across all savers, and that's something which anybody can do. So one doesn't need to have very large amounts of capital to begin with. So there is a joke that goes around that unless you have a lot of money, you can't make a lot of money. But in mutual funds that may not be so true, which are backed by equity stocks, that you may start with a small sum, and we're talking about 4-time multiples. We're talking about compounding which is way beyond our understanding. And eventually you realize that you have a lot of money. So you start small, it's possible, it's cheap, and over a period of time you have all the tax benefits going in your favor. So I really can't understand why people look at these sale events with a lot of trepidation. But I tell you that it's not something that can be changed overnight. It's a perception. And if you were there on the sale day, if you watch TV, if you watch the markets, I don't think you got any encouragement. People were just emphasizing the negatives. So what would you think an average investor is likely to do? I don't think he's just going to jump in because everybody is negative, right? So I think there is a lot more to it than all of that. The ingrained nature of aversion to risk is something which is very common to all human beings. So I'm saying don't change that. Don't try to time this market at that time alone, but just inculcate a habit of putting some money away on a regular basis over long periods of time, and you're there.
One thing.
Yes, please.
There is this thing that we always say that there's a difference between timing the market and time in the market. So equities is not about timing the market, it's about time in the market. The longer you stay, the more that it multiplies, the compounding effect takes hold.
A very common fear when I meet a lot of investors and some of our viewers is that I've never lost money in property. I've never lost money in my gold investment, but somehow I have lost money in stocks. How does one address that?
No, that's not entirely true.
If I look at the number of great companies, they are a handful. If I look at a number of mediocre companies, they are, let's say, a couple of dozens. But if I look at a number of bad companies, they are like lots of them. So not every company makes money. Just because you're buying stock, that is no ticket for you to make money. You buy property, maybe 2 years, maybe 3 years, maybe 5 years, you will make money. You buy gold, the perception is you'll never lose money.
That statement is not entirely true, although a lot of people believe in that. For example, gold has not given positive returns for many years now. And also, if you look at the long-term returns of gold versus equity, I think equity clearly outpaces gold returns. In India, people have made money in gold not so much because of the USD price movement, but because of the rupee depreciation. So it's been a hedge against rupee depreciation rather than that particular asset class itself giving you returns. And by logic, gold cannot give you more returns than equity because there are no economic benefits from gold. There is no cash flow from gold. So it's just an asset which has nothing of this compared to equity. And over a long period of time, certainly it can't give you better returns than equities. The only issue on equities, as you mentioned, I think there are too many stocks to choose from. And that is where investors invariably go for a smaller price or penny stocks because they believe that investing, let's say, 15 rupees in a stock is much cheaper or attractive, and they get burnt without analyzing the companies. I think all those investors who cannot put full time into stock markets, I think it's better to come through mutual funds where there is a professional fund management team which handles these issues, and also there is an in-house research team which supports that fund management team, and you will be able to go through these volatile phases without much of heartburn. I think for all those investors who can't really analyze companies and invest in stocks, mutual fund is definitely a very good route because there is diversification in portfolios, and that also reduces volatility of returns. And as Tushar said, I think it has to become a long-term habit rather than one-off event just because everybody is talking about stock markets. One should not be investing. In fact, the best time to invest in stock market is the time when there is too much of negativism.
I think one of the finest things about India is the exchanges we have. One of the finest thing about India is that how finely the market is regulated. I mean, we've got some of the finest regulators, RBI, SEBI, which are just ensuring that this is a safe market. It's a market which does not have any systematic issue. Pay in, pay out, they're completely mapped. I mean, that is the beauty of Indian market, isn't it?
Yes, very true. I think we have had our share of scams in the country, but frauds and scams will keep happening in any economy, in any country. But I think by and large, our trading systems, our regulators have been one of the finest. And when people are investing in equity, you need to be aware of these pitfalls. And as long as you take care of those risks, I think it's fine.
Tushar, I mean, we've got one of the finest, both in terms of regulation and in terms of the diversification and in terms of opportunity. I mean, this is one of the finest market in the world.
I would just say that anything becomes safe as long as it's transparent, right? So as long as you know who and what is the volume at the end of the day, the market is safe. You are buying what everybody knows what you're buying, and that makes it safe. The rules are there. I think they were always there. The point is, as long as you make it transparent, it just induces everyone to follow the rules. And I think that is what we have as an exchange. So that makes it probably the safest.
I just want, Harsha, one closing comment from you on the retail participation. There are early signs, there are green shoots. I won't say there are tall trees, but last week when markets fell, and in the month of August when 15,000 crore of FI selling happened, the markets didn't panic. 6-7% down on the index. I mean, that's we as a country, I think we're moving in the right direction.
Correct. I think this is the first time, at least in my career, where I have seen FIs have been selling so sharply, and at the same time, the retail investors in India have been putting money into mutual funds and stocks. More or less, the amount of selling that has happened on the FIs has been compensated by mutual fund buying. So that's a great change that we have seen in the recent past.
So, gentlemen, thank you for your time, and I think we ultimately come to this whole point that equity is nothing else but buying future purchasing power. If you believe in India, it is important to have an equity allocation, and one of the finest part, Tanveer, about Indian markets is that it's the exchanges, it's the regulator which have really made all the difference. They certainly make all of us very proud.
Yes, indeed. The overall environment is very conducive. Thanks very much, Nikunj, and our panelists for this very insightful discussion. Ladies and gentlemen, could we have a loud round of applause, please? May I call upon stage now Mr. Ravi Varanasi from Chief Business Development, NSE, to give the vote of thanks.
Nivesh India is an important milestone in our journey towards in our journey of creating investor awareness across the country. I thank Mr. UK Sinha, Chairman SEBI, for taking time off from his busy schedule and gracing this occasion and sharing his thoughts on this area. And SEBI has been creating an ecosystem which kind of thrives and which allows intermediaries and other participants to take the cause of investor awareness further. It has been a great, we are very happy that Mr. Sinha is here and to flag off this particular event, and thank you very much, sir. Before this, we had the panel discussion, Harsha, Tushar, Kumar, moderated by Nikunj. It was a very, very interesting panel discussion. A lot of insights have been shared, and all the panelists have done a fantastic job of actually figuring out how the investors should be brought into the market. I'm sure that insights shared by them are very useful for the audience. Thank you very much, panelists. All of you will join me in wishing all the success for the initiative which has been taken by NSE and ET Now. Thank you very much, all of you, for joining this event.